Welcome to Conversations, Season 2 of the MTA podcast series, a weekly audiocast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association.
This is Tim Braun with the Minnesota Chapter of the MTA, and with me today I have Steve Leuthold. He is the founder and board member of the Leuthold Group and director and board member of the Leuthold Funds. With over 50 years of experience, considered to be an expert in the industry, Steve has made several appearances on nationally broadcast financial programs, has served as the contributing editor and author of articles from major publications, and is frequently cited in leading trade journals. He has conducted seminars at universities and made presentations at meetings and investment conferences throughout the country. Prior to founding the Leuthold Group, Steve was an officer and portfolio manager of two mutual funds for the Criterion Investment Management Group, and he was also the officer and investment strategist at Piper Jaffray and Hopwood. Steve has also previously served as the board of directors for the Whedon and Company LP, an institutional equity firm. Steve, it is my pleasure to have you join us today. And one of the things that you presented to us today was the 10 things that Steve has learned over his career. Now, while there are 10 things in the list, and this is a rather short podcast, the takeaway that I had from your presentation was that inevitably things change. But there are a few observations that I think we can all take away from this market. Correlation of assets has been high, approaching the seemingly one as we've gotten deeper and deeper into this decade. Increased volatility and higher levels of seasonality. In your opinion and experience, how should we be dealing with these types of characteristics in the market?
Well, I think the first thing on my list with these 10 golden rules, so to speak, is to know yourself. I mean, we all have frailties, inconsistencies. Some of us will not ever admit we're wrong, and some are just chronically negative and pessimistic about things, and you've got to recognize these things in yourself in defense against them. My big frailty for about 10 years was I was enamored with science and technology probably to a degree that wasn't very healthy. The other thing that I think is really important when you're running an investment portfolio is to be disciplined in your decision-making process. We do a lot of quantitative work, and we also do a whole series of things in our analysis of the market as to whether it's healthy or unhealthy. And these are put in a box and evaluated individually. We do 170 some indicators every week on the market, and all of this is an effort to keep emotions out of our investment decisions. Our biggest problem as investors is our emotions and controlling them, either being too pessimistic or far too optimistic at market peaks. And you should develop disciplines that keep this from happening to you, whether they're valuation considerations or whatever. I think we try to look at it in terms of the economic and monetary work, and we have a whole segment of what we really call momentum, which is mostly technical things, and we also have intrinsic value, which are 28 different benchmarks of value measurement from PEs and price to sales and a whole series of things. And we probably go overboard in it, and people have called us chronic collectors of economic trivia, but the more you have, the more you figure you've covered most of the bases. And the most important thing, I think, in running a portfolio is having aggressive and flexible asset allocation. We have never been 100% buy and hold type of organization, 100% in equities. We rarely will, our range is between 70% in stocks and 30% in stocks. There have been some times where we've gone below 30, like in the year 2000, but that's kind of the frame we operate in, and nobody should be 100% invested all the time.
Do you think that, you mentioned discipline, and that has a tendency to maybe keep you in the right place. Do you think that this volatility in this market is symptomatic of lack of discipline?
No, I think the volatility in the market is primarily the result of a breakdown in the market mechanism, where the trading is all in or all out. And that's partially a result of so many people trading ETFs, spiders, where they're buying or selling 500 stocks at a time, and this is also why things are so correlated, as you mentioned. We also have the new event, or relatively new, which are the high-frequency traders that really distort volume and account for sometimes 70% of the volume on the New York Stock Exchange stocks in a single day. And there has to be something done, I think, to take those volatility factors out of the market and maybe even reinstate some of the old things we had, like an uptick rule for short selling.
Do you see anything on the horizon that would likely change some of those characteristics to kind of drive some of those negative aspects out of this market?
Well, you've seen an effort to do that in London, and where they have put an extra fee on trading that would make a lot of the high-frequency trading unprofitable for people. And when you look at these guys...
Oh, I'm sorry.
Well, who's that on the phone? Is that your wife?
Probably.
Well, bring her into the conversation. No, and they have put it's a relatively small tax on transactions, but it is enough to discourage the high-frequency traders and discourage their activities, where they can now make money even if a stock is bought and sold at the same price. The other thing I think that probably should be done, I think there should be some more controls based really for some of the ETFs that are buying or selling in large packages of stocks every day to balance out their cash flow inflows and outflows.
Very good. What, Steve? We know many people know that you have a wide variety of indicators. What are your indicators telling you now?
Well, usually they're telling us something. Right now, we are mired in neutral territory. We have something like 1,785 positive points and 1,774 negative points, and that's about as close as you can get. We do a ratio between the positives to the negatives, and unless that gets up to, we have a little fudge factor, it has to get up to 1.05 positives before we would be really constructive toward the market. And just like on the downside, we'd have to get off of this neutral zone and get down to, say, 0.95, where you have more negatives and positives. Right now, it's neutral. I don't know what to expect of this market on a shorter-term basis. We're 50% in equities, and that also is a neutral status for us.
It's a photo finish.
Well, yeah, it is, but it's frustrating.
That it is. That it is. Well, I want to thank you very much for your time and commitment to the Minnesota chapter of the MTA. Steve, thank you very much. It's been our great pleasure. This is Tim Braun, from co-chair of the Minnesota chapter of the MTA, wishing you all a solid uptrend.